In this learning, we are talking about free cash flow to the firm, and we are calculating it from EBIT EBIT. So here basically we are being introduced to two concepts. One is EBIT, which stands for earnings before interest and taxes, and the next concept would be EBITDA, which we call EBITDA, and it is earnings before interest, taxes, depreciation and amortization. But in this learning, basically we are calculating the free cash flow to the firm from EBIT. So whenever earnings before interest and tax are given, we will multiply these earnings by 1 minus tax rate. So it would essentially reduce the earnings by the amount of tax, and it would become earnings before interest only. And then we will add depreciation, assuming that depreciation is the only non-cash item here, and then we will minus fixed capital investments. So fixed capital investments are nothing else but changes in the fixed capital, especially the investment means it is increase in the fixed capital. So if there is any increase in fixed assets or fixed capital, definitely it involves outflow of cash, and that would be minus here. The same way working capital investment means maybe this year there is an increase in working capital, and this increase in working capital might have involved cash outflow, and this is deducted here. So this is the formula that we use to calculate free cash flow to the firm from EBIT. Let us work this one with some example here. And here there is an example where this company has EBIT, EBIT of $500 million and EBITDA of $800 million, and we are calculating the free cash flow to the firm starting with EBIT here. When we are starting with EBIT, which is definitely $500 million given here, we will multiply it with the 1 minus tax rate, and in this scenario tax rate is 40%, so we will do 1 minus 0.40, so 500 times 0.60 essentially gives us $300 million, so we will write this number here. So this is EBIT multiplied with 1 minus tax rate, and then we will add the non-cash charges. So this depreciation is assumed to be the only non-cash charge, because when we have this number EBIT and then we have this number EBITDA as well, EBIT is $500 million and EBITDA is $800 million. This is EBIT here, $500 million. So this is earning before interest and tax, so it means depreciation has already been deducted, but this is earning before interest, tax, depreciation and amortization, so it means 800 is the earning when depreciation has not been deducted. So in a nutshell, $300 million would be the depreciation. So assuming that this is only the non-cash charge, so this is also added back here, $300 million. Less net investment in the fixed capital, we will see this number. So net investment in fixed assets have gone up by $400 million, so this number would be deducted from the number we have, and then minus working capital investment. To get this number, actually we are in cash flow statement, and in cash flow statement there are three portions of cash flow statement. We know that cash from operating activities, investing activities and financing activities. Working capital is a part of operating activities, and here we see that there are some changes happening in the working capital. These changes are given here. Account receivables have increased by $40 million. Inventories have increased by $30 million, so these are minuses, and accounts payable have decreased by $15 million, so this is a positive number, and similarly accrued expense is a positive number. So if we do working capital, and working capital we know in valuation is current assets minus current liability, but in current assets we mainly consider account receivable and inventories, and we don't consider cash and cash equivalents. So going by this definition, so current asset changes are minus 70, this 40 plus 30 in minus terms, and current liability changes are plus 25, this 15 plus 10, and overall change in working capital is minus 45. So minus 70 plus 25 is minus 45. So this is investment in the working capital, and it would be a minus number for us in this adjustment. So it would be minus 45 here, and then we get the free cash flow to the firm, and this number comes out to be 300 plus 300 minus 400 minus 45. It comes out to be $155 million. So this is free cash flow to the firm, and we computed it by starting from EBIT, that is earning before interest and tax.